all throughout 2022, the things that I look at were going in the bearish fashion. So global liquidity by central bankers and things like that, things that I watch closely, and what is the Fed doing? Liquidity was contracting throughout the world from basically Q4 of 2021 all the way through 2022. The dollar was strong, right? We've been talking about what are the treasury markets doing? Well, they've been inverted and severely inverted for quite some time now. The Fed has been tightening, right? They've been raising rates, and so what has changed now? Here's what's changed basically since 2022. Liquidity now looks like it has bottomed. In fact, global liquidity is actually slightly on the rise again if you factor in what China is doing. The dollar broke quite a while ago, a few months ago, in the fall basically, and has been basically breaking down, and it doesn't look like it's going to peak anytime soon or perk up anytime soon. It's just kind of flailing at 102 right now. VIX volatility has been kind of high and volatile, for lack of a better term, throughout most of 2022. Now it's just kind of sitting comfortably at around 19, and it also doesn't look like it wants to go up anytime soon. Whenever we saw these setups in 2022 with a low VIX, and we saw peaks in risk assets like stocks, like Bitcoin, like crypto, whatever, that was the time to put on a short and to bet against it. I would tell people to, what I'm doing is I'm shorting any rip that I see. But now when you have this regime change where now the dollar is weak, where volatility is low, where liquidity is actually now being added into the system on a net basis, this is the time to start leaning long. So this is the time where I'm starting to looking at buying the dips instead of shorting the rips.
Interesting. Okay. All right. We just showed the Dixie chart there on dollar, and you're right. The likelihood of seeing a recovery back to what we've seen over the past bit of time here, all the way back into December, it's really been on somewhat of a decline outside of that little bit of a pump right here in early January. So definitely right. Same thing with the VIX, to your point, really trending also into those cycles. So there are some signs out there pushing. I want to go back to this tweet right here. You had high yield, aka junk bonds, also risen over the 200-day moving average, first time since Q4 2021. Another bullish momentum shift. Explain this one a little bit for me.
Right. So a few things are as risky or as considered risk assets as junk bonds, right? I think you could throw crypto in with that, things that are considered to be the most risky of the risk assets. High yield junk bonds have actually reclaimed the 200-day moving average, which lots of institutional investors use to signify, is this bullish or is this bearish? It's the first time it's been in bullish momentum since way back in Q4 of 2021. And you can go across the board. I did this. I have another tweet where I went through and basically just listed them. The S&P 500, the Dow Jones Industrial Average, small cap stocks, mid cap stocks, high yield junk bonds that we just talked about. Bitcoin just recently reclaimed it on Friday, the 200-day moving average. You can go overseas and look at things, emerging markets, Chinese stocks, European stocks, which surprises a lot of people because they're doing so terribly there, right? We're so concerned about where they are with their high energy costs and their recession and their consumer sentiment. Everything looks negative, but in spite of all that, they've regained their 200-day moving average. They're all showing bullish momentum. And when you see all of that happen across the board, I think ignoring that is just basically to your own peril.
Yeah, I think the scenario that has occurred here is the speed in which this has moved here in the last 30 days. We've seen a lot of scenarios that played out. Most likely, the question is how is this going to play out for Powell and how he'll address this with the upcoming FOMC meeting. What are your theories right now with the way the Chair Powell might be looking at the data coming in right now?
Yeah, absolutely. So first of all, I think they've got to be happy that they're seeing some solid and steady disinflation, right? We peaked, obviously, I think in June with a CPI above 9, and now we're in the 6s. That's good, and that's an encouraging sign. He said over and over again that he needs to see sustained lower inflation. He needs to see it moving towards the 2 to 3% range before he would do anything differently. I think that the bond market has already signaled that, you know what, Powell, you've gone far enough. The 2-year Treasury yield, which generally historically has acted or served as a cap to the federal funds rate has already peaked and has come down. It's currently, as we speak, is sitting at 4.19%. The federal funds rate is well above that right now. So what that tells me is if he continues to raise, the bond market is not going to like that. The bond market is signaling you've already gone far enough. And so maybe he raises another 25 bips. Maybe they go another 50 or 75 bips over the next couple of meetings. That's definitely possible. But I think what the markets are sensing right now is that the Fed is going to pause. And the Fed officials are already talking like this, right? They've gone from 75 bips per meeting down to 50. Now they're talking about 25. That's already basically baked in for the February 1st meeting. In the past, when we've seen the Fed pause after they've hiked rates up to a certain level and then they pause, that's when you see a rally and almost across the board. I think every time, at least for the first several months, you see a rally in risk assets. So I call this the Fed pause rally. I think it's real. Now, I want to caveat all of this by saying when the Fed is forced to pivot at some point, and by pivot, I mean start lowering rates rapidly, that almost always is during tough times. So that usually means that the floor is dropping out under risk assets. That means that we're in the throes of a recessionary bear market. It means they're actually nervous and that something is happening in the bond markets that are forcing them to jump back in and become active participants again. That still lies ahead of us. I just don't know when it was. To be honest, and when I've been on the show in the past, I thought it was going to happen in the first half of 2023, so I thought we'd be in it. But as the data keeps coming in, it continues to look like it's being pushed out further and further. So I don't know when it's going to happen, but I'm going to enjoy this risk-on rally for the time being, and then get ready to probably take profits and to use trailing stop losses, because I think we have lower to go at some point, maybe the second half of 2023, maybe into 2024. I'm not quite sure on the timing.